Topic explains the concept of weighted average cost of capital, WACC, and its importance in corporate finance and investment analysis. WACC represents the average rate of return a company must pay to providers of capital, including debt holders and equity investors. It reflects the opportunity cost of financing corporate operations and investment projects. Because firms finance activities through combinations of debt and equity, WACC combines the required returns for each source of financing according to their relative proportions within the capital structure. Analysts and managers use WACC extensively in capital budgeting, valuation, and strategic decision-making because it serves as the minimum required return for value-creating investments. The topic explains that WACC is calculated by weighting the after-tax cost of debt and the cost of equity according to their market value proportions within the firm's capital structure. Debt financing typically carries lower cost because lenders face lower risk than equity investors and because interest expenses are tax-deductible. The after-tax cost of debt therefore equals the borrowing rate multiplied by 1 minus the corporate tax rate. Equity financing is generally more expensive because shareholders bear greater risk and expect higher returns. The weighted combination of these financing costs produces the company's overall cost of capital, representing the return required to maintain investor confidence and firm value. Estimating the cost of equity is a key component of WACC analysis. One commonly used method is the Capital Asset Pricing Model, CAPM, which estimates the required return on equity based on systematic risk. Under CAPM, the cost of equity equals the risk-free rate plus the equity beta multiplied by the market risk premium. Beta measures the sensitivity of a company's stock returns relative to overall market movements. Firms with higher systematic risk generally face higher equity costs because investors demand greater compensation for uncertainty. Analysts evaluate the cost of equity carefully because it significantly influences valuation models, project analysis, and assessments of corporate financial performance. The topic also discusses how capital structure decisions affect WACC and corporate value. Increasing debt financing may initially lower WACC because debt is typically cheaper than equity and provides tax advantages. Moderate leverage can therefore improve shareholder returns and enhance firm value. However, excessive debt increases financial risk, raising both borrowing costs and required equity returns as investors demand greater compensation for default risk. Beyond a certain point, additional leverage increases WACC and weakens financial stability. Firms therefore seek an optimal capital structure balancing the benefits of debt financing against the risks associated with higher leverage and financial distress. WACC plays a central role in investment and capital budgeting decisions because it serves as the discount rate for evaluating future project cash flows. Projects expected to generate returns exceeding WACC generally create shareholder value because they earn more than the company's financing cost. Projects with expected returns below WACC should typically be rejected because they reduce firm value. WACC is also widely used in discounted cash flow valuation models for estimating the present value of future cash flows. Because WACC directly affects valuation outcomes, analysts must estimate it carefully using appropriate assumptions regarding market values, financing costs, and capital structure composition. Overall, topic emphasizes that WACC is a foundational concept in corporate finance, linking financing decisions, investment evaluation, and firm valuation. By combining the costs of debt and equity financing, WACC represents the minimum return required to satisfy investors and maintain corporate value. Accurate estimation of WACC supports better capital budgeting, valuation analysis, and strategic financial management. Changes in leverage, market conditions, risk perceptions, or interest rates can significantly influence WACC and corporate profitability. For CFA candidates, understanding weighted average cost of capital is essential because it affects investment appraisal, equity valuation, financing strategy, and long-term shareholder value creation across all sectors of financial analysis.